Hello, Baker Finance students. We are now approaching week 6 and hope everybody had a good weekend. Stock market was down a little bit last week, but overall for the year, still looking very positive. And unemployment numbers weren't as good maybe, but still some concerns internationally. But for the most part, we've had pretty strong markets in the recent years. So I think the Dow is well over 16,000 now, and be interesting to see where it ends up at year end. But for this week, we have two shorter chapters. The first chapter, chapter 14, looks at short-term financial planning. And as a business is growing, hopefully it does grow. I'm kind of one that strongly believes that if you're not growing, you're becoming stagnant, or if you're not changing, you're going to be out of business soon. But in anticipating for additional growth, you're going to need additional cash. You're going to need additional financing. And one of the ways that we can project how much cash is needed is by doing a sales forecast. And that also create pro forma statements, which are based on a lot of times percentage of sales. Say if sales were to increase by 10% the next year, we're probably going to have to come up with some additional discretionary financing in order to support purchase of additional assets, whether it's to make something to ultimately meet the demand for the consumers or buy more inventories to sell. We're going to have to tie up a little bit more cash for a while. Eventually we'll get that back as we sell the products, but we're going to have to potentially make some more investments in plant and equipment and inventories to meet that increased demand in our growth. So when you kind of look at this chapter, there's definitely some limitations when looking at percent of sales methods, but and it can change, based on your need for plant and equipment. It may not be so linear; it might be a little bit more lumpy due to what the textbook talked about economies of scale. May actually experience lower per unit cost as we grow, but they may require more plant and equipment that can significantly increase cost as we grow. And in terms of trying to figure out your needs for the year, the good thing is to look at a cash budget, because cash flows vary throughout the year, and in finance, cash is king. So there's going to be some months when I may actually not have enough revenues to meet my cost, and I may have to go out and borrow for through a bank loan or a lot of different items that they talk about in the next chapter, chapter 15, lines of credit, commercial paper. But the idea in the end is that we'll recoup that back, that we're going to eventually be able to pay down those loans and make a profit from it. So, and tying into that next chapter with chapter 15, it kind of looks at some of the cost of these short-term credits. It's almost like a debate about which approach do you take to finance your assets. Probably you should do some matching, that if it's long-term assets, you should probably finance it with long-term debt. If it's short-term, keep it short-term, and there's different ways we can do that. It can be done short-term by just negotiating credit, such things as accounts receivables, accounts payables, or it might be with dealing with banks. But we need to examine the cost of doing such. And typically, we go back all the way to the beginning of the book. The longer that we go out in borrowing, the higher we would expect the interest rate cost to be. Now, right now, interest rates are super low, so the idea is to keep interest rates low to try to stimulate investment in the business world, that they will go out and purchase more assets and resources. And that has been a benefit for many corporations right now. In fact, they probably have refinanced some of their debt to get the lower interest rates right now. But with that, it's ultimately it's a trade-off. You could decide to take out a 30-year mortgage. For you individually, you could take out a 15-year mortgage. This is a good example where the 30-year mortgage is going to have a higher interest rate, but the 15-year mortgage is going to have a lower interest rate, and you could actually save a lot of money in interest payments over a period of time. But it comes to the reality, can I make that higher payment every month with a 15-year mortgage? So you might put yourself in a cash crunch. So corporations have to think about that same thing too. When I worked in treasury departments in big corporations, I'd have to figure out every day how much money we did or did not have. I'd have to go out to the market and borrow money if I needed to, mostly through commercial paper. But I would do long-term projections of our cash needs. And I always make sure that I didn't have everything maturing in my credit on the same day. In fact, Some of the worst days are what they call month end, then the next worst is quarter end, and the very last you have all three, which you have month end, quarter end, and year end, December. So I'd have to really plan out and look at everything that I was borrowing to make sure that I don't have so much maturing on the same day. So when I talk to the traders, I'd say, nope, got to X these days out. It's got to mature on the next day or the following day, because I can't have too much debt maturing in one day, because it just becomes hard to come up with cash, and it's going to cost you more too if you go out to the market and try to borrow cash. People in the market are going to know this, and they're going to ask for a higher interest rate too. So, but one other thing they talked about in this chapter was the cash conversion cycle. Companies like Dell have been really good at even almost making this negative. But that's the time we try to get our money back into the company as I sell a good or service. You want to try to minimize this because cash has opportunity cost to it too. If I don't have the money available, I'm going to have to go out and borrow money and pay an interest rate on that. I want to try to reduce that liability as much as possible. And then finally they talk about some of the different ways that we can calculate these cost of credit. Also they give examples of not taking advantage of cash discounts. If there's a 2% discount if you pay it off in 10 days versus 30 days, it really behooves you to take that 10-day payment and make it, because on an equivalent annual basis, that cost could be up to 35 to 40%. Even though it's just for that month, it's saying, well, if I converted that amount of interest rate that I paid for that month times 12, that's where they would come up, say a 30 to 40% opportunity cost and not taking advantage of that discount. So, and then they mentioned some other examples, different ways. Corporations can go out and finance money. A lot of big corporations, they use the commercial paper market for their short-term borrowing. And I can remember one time I had almost $5 million in commercial paper outstanding, and we decided at Sprint just to convert it all to long-term debt. So I actually managed to spend that $5 billion in 1 week just paying off the commercial paper. But it made it a lot easier to get through every day because you weren't dependent on going to the markets. And we would set up things such as lines of credit with different banks to issue that commercial paper. But the idea with lines of credit is you actually never tap them. It's just kind of a backstop. And I'd have to pay pretty heavy fees, and I'd negotiate fees with different banks just for the right to borrow money if I needed to. And you as individuals, our forum discussion will tie to this in personal finance this week is, what happens if something bad does happen? Something breaks down, a car, major damage to your house. Do you have any liquidity available now, a reserve if you will, or if you had lost a job, do you have a backup line of credit? Because typically once things go bad, and if you don't have anything there as cash or a backup line of credit, you have to depend on interest rates on credit cards, which are super high. So it's not a good place to be in. So this week's forum discussion, I'm going to include a little bit about tying corporate finance to personal finance to help you think about it a little bit, your own situation. So, well, that's it for this week. So I hope everybody has a great week, and I will talk to you online, but just keep plugging away. We only got 2 weeks left here, so we're on the home stretch. Take care.